Good evening, everyone. This is our fourth and final installment of our FOD Financial Literacy Series. As you all know, our esteemed guest has been giving us all of this great wisdom on finance. I will turn it over to her. Thank you, Miss Anthea Perkinson.
Thank you, Anthony, and welcome back, everyone. I'm glad that we've got a pretty good turnout, and I think we'll be expecting more as time goes on. This is the final session for this year's FOD series on managing your finances. And this year, we're doing something a little bit different in light of the pandemic and in light of a lot of advice that I've been asked for over the past year, how to manage your finances in an emergency. Obviously, going through the pandemic with the shutdowns, with people laid off, with all of the uncertainty, was a good exercise in financial emergencies for many of us. But it's also good to have taken notes on how we responded, to know what to do if you face another financial crisis. And these can come in a variety of forms. You may find yourself unemployed at some point or needing to take a leave of absence at work in order to care for someone in your family, for example. There can be a whole host of reasons that you might need to think about, what do I do in a financial emergency? Very straightforward agenda. We're going to talk about what are your financial priorities in a regular period and when you are facing some form of an emergency. Do you have a spending plan? Yes, we're going to harken back to our first session on the importance of having a spending plan in periods of transition. And as I probably said during our first session, I'm not necessarily somebody who says you need to have a budget and maintain it accurately, completely every month of every year, forever and ever. But in periods when you are facing a big financial change, your fortunes are looking very different going forward, putting together a budget can be a really, really helpful exercise. We're going to talk about places to find money, how to expand your spending power, how to manage your credit and credit profile, and then accessing investment accounts. When you are in your regular life and things seem to be going along well, most of us are focused in terms of our spending decisions on lifestyle issues. Are we going to take a vacation? Should I buy a new wardrobe for the spring? Should we upgrade some furniture around the apartment? So most of us are in that mode of just thinking about our lifestyle expenditures. When an emergency hits, and again, we saw this last year with the rollout of the pandemic, March into April, all of a sudden, many of us were very focused on our financial security and being able to pay the bills. That's what solvency means. Can I pay my electric bill? Am I good for the rent next month? A lot of people, unfortunately, as certain industries literally shut down overnight, travel and tourism, gym, personal care, all of those people were literally without paychecks in very short order. It was all about keeping hold of their apartments and making sure they could pay for food and medicine. As we got out of the emergency situation, then you can focus on repairing what happened to our credit if we ended up in debt, rebuilding our savings, and renewing our commitment to our financial goals. So as we're sitting here today, and as we think about a potential new financial emergency, it's important to understand how we each individually define financial security. There's some people for whom having just $1,000 in the bank is all they need to sleep well at night. And there are others who need to have not only a big bank account, but investments that they have access to. I mean, everybody defines financial security and what lets them live comfortably very differently. When you're facing an emergency, a period when you are not going to be expecting a regular paycheck, how will you stay solvent? How are you going to pay your bills? It's very helpful to think about that in advance so that you're not trying to make decisions when you're panicked. And in that situation, as we saw last year, those people who exerted control over their finances, who put together a plan of some sort, whether it was applying for unemployment insurance, picking up gig work, exerting control over your finance will enhance your emotional and financial well-being. It will certainly help you get out of panic mode. How do we improve our security and solvency? Number one, here again, plan our future spending. In every life transition, I encourage this. So as you are entering graduate school, exiting graduate school, planning to get married, planning to buy an apartment, considering a new job and maybe a move across the country, putting together just a very simple written budget so that you understand the expense decisions you're making is super helpful in terms of making good, solid financial decisions. The other thing that is helpful to do in periods when we're relatively comfortable, we may see danger on the horizon, it's to imagine the worst case scenario. What if I lost my job? What if we had a week where the stock market, like it did today, went down by 2%? What would I do? And thinking through that and having a plan when you're calm, cool, and collected makes for a better decision. Identifying how you would pivot, what you'd be willing to do, whether it's move, downsize, sell things, whatever, knowing in advance, making those decisions that you'd be comfortable with is very, very powerful. The other thing I will advise people to avoid, because I see this a lot as a financial planner in private practice, many people get themselves into a bad situation financially and spend more time beating themselves up over the purchases they made, the credit cards they ran up, the car lease they signed at the wrong possible time. That is not helpful. In fact, it is debilitating and it diminishes your ability to make solid financial decisions. Ruminating about these past ill-timed decisions is not helpful. So we want to avoid that and do the debrief later. Take control of the situation. You're facing a bit of an emergency or anticipating one. So for example, with a lot of my corporate clients, a lot of them have come to me and said, you know, I'm noticing that there are not as many people and new contracts coming in. There's a good chance that there may be layoffs. And I'll say to them, all right, let's put a plan together. Let's go over your budget. Let's see how you're positioned. Let's make sure that you've got great spending power if you end up having to look for a new job because you're laid off. Creating that new spending plan, you're going to be laser focused on the essentials. You're not necessarily going to be putting, an allocation in there for your vacation later this year. Let's make sure that you can continue to pay the rent, buy food, etc. Your focus in an emergency, any kind of an emergency. This applies, for example, we had Hurricane Sandy. Preserve cash. It's fine to use credit cards in an emergency. Hold on to the cash in the bank because that's harder to replace. You can always dig yourself out of debt. So your budget is going to be focused on the essentials. It's going to be focused on preserving cash savings and making the most of a lower period of income or a period of lower income. And we actually have now a case study. So we've got empirical evidence that just about everybody in New York City in particular can examine. All of us went into lockdown in March. Part of March started off kind of normal. And then by the middle of March, pandemic was declared. We had a state of emergency. People were staying home. Subways were empty. Restaurants were closed. We're all hunkered down. April, we spent the entire month of April in that lockdown situation. In July, the emergency was lifting. Restaurants were opening up, the weather was fabulous, and people were out and about. So now what we can do is look at our credit card statements from those 2 months specifically and see, how did I spend my money in April and in July? And it is remarkable to look back and realize how your lifestyle changed and the things that you didn't spend money on when you couldn't. Travel, dining out, hair care, entertaining, live events, etc. So in lockdown, we had a pretty constrained situation, but it tells you if you were in a similar emergency or one where you really needed to dial back your spending, you've already proven to yourself that you can do it. Now, if we looked at and compared our April and July bank statements, we can see in dollar terms what it is like to be in total lockdown versus having a quasi-normal month of spending. So here you have your essential expenses distilled. So if you looked at your April bank statement, you're probably going to notice that the ATM withdrawals were much diminished, your debit withdrawals were lower, your electronic or Zelle payments and your cleared checks are much lower in April than they were in most other months of last year. This is probably going to show you what your essential expenses really add up to. If you've never sat down to build a budget, this would be a good place to start, to look at what does it actually take to pay the rent, buy food, and not much else. It's interesting to consider how much more most of us spent in July. We could go out with friends, eat outside, travel a little bit, particularly in state, and most people did that. They needed the opportunity to get out and about and see people. But it does help us now to understand if we really had to, we could lock it down pretty tight from a spending and expense standpoint. When you put together your emergency spending plan, it's going to reflect your current priorities and the possibility that you might not have income for quite a few months. So for example, if you are expecting to get laid off, you want to do a quick add up. What's it cost for food and medicine each month? What are my health insurance and other insurance premiums? What about the utilities, rent or mortgage? Staying current with my credit card debt, maybe not paying it off. You might be forced to consider just minimums and staying current with any bank loans that you might have. Certainly with student loans, although I do recognize that right now, under the CARES Act, federal student loans do not have to be repaid. And that has been extended until September of this year. Next, as we are going to look to preserve cash, it's important to think about knocking out the expenses, the recurring expenses, some of them auto-billed, that we're not really going to keep in a period of an emergency. So for example, as most of us did, suspend the gym membership, couldn't go anyway. So take that out as an expense. If you have unneeded subscriptions, and subscriptions come in all different forms. It's electronic, it's magazines, it's entertainment, it's all kinds of stuff. Everybody wants the subscription model because it's a recurring revenue stream to that business. But if you're in a situation where you need to cut back, this is a good place to start looking and turning these things off. If you have auto billing on certain bills that are not going to be material, if you're laid off, not working, like a monthly commuter ticket, that would be a good thing to suspend. It's a good time to renegotiate your cable package, your cell phone plan, your data plan. They will negotiate with you. You just have to be persistent and polite and see if you can get your bills reduced. Automatic renewal memberships and contributions, these can be turned off even for a temporary period. And then of course, if you're not going to be driving, which was true for most people during the pandemic, you can update your expected mileage and lower your premiums with your auto insurer. Other ways to preserve cash if you need to go a little deeper. Cable is great, but cable is not an essential if you really needed to tighten the belt. Same thing with landlines. These are quickly becoming a thing of the past. Annual credit cards, annual fee credit cards, and we're going to talk a little bit more about credit cards toward the end of this presentation. If these are not cards you use and you're paying these fees because maybe you get rewards, travel rewards, but you're not going to be using those travel rewards, might be time to replace these with free cards. Indoor parking, that can be a luxury item. And if you can get it back when things turn around for you, it might make sense to cancel it for a period of time. And then if you're really pressed, do you actually need a car? Particularly a car on a lease can be a big monthly expense. Now let's talk about finding money. If you're in a situation where you're looking to shore up your solvency, this is an important thing to do. Put your hands on money that belongs to you. Great place to turn is a website called missingmoney.com. It takes you to the state comptroller's office in all the states that participate in this aggregator website, and you search by your name and address and see if any money has been turned in. And money that ends up with the state comptroller's office can be things like cable service deposit, a security deposit box deposit, an apartment security deposit, life insurance proceeds. You may have a favorite aunt or uncle who, unbeknownst to you, made you the beneficiary of a life insurance or an annuity policy. They pass on, you don't even know about it, so you don't think to look, and they can't find you, so the money eventually ends up with the state. If you've ever received a gift card as a rebate of sorts from a company and you don't spend it, that too will end up as a credit with the state. Other opportunities, if you were due a federal tax refund any of the past 3 years, so going back to 2018, 19, or this year, if you made less than $57,000 in 2020, you can use Free File. Actually, some of them will go up to 60,000 adjusted gross income. You can apply and fill out the past tax return and get that refund sent to you. If you were eligible for a stimulus check but didn't receive it, and that could be because you didn't have to file taxes in 2018 or 19, you can file them and claim that stimulus, which is a helpful amount of money. If you have a dependent kid, a child who had wage earnings less than $12,400, and most kids in college or high school didn't make more than $12,400, if they were claimed as a dependent on your tax return, they had withholding from their paychecks. They can file a tax return, indicate that they were a dependent, and get their federal tax withholding returned to them as a refund. It can be a few $100, which is kind of nice to have. If you might have been eligible for the earned income tax credit in earlier years, and again, you can only go back 3 years, and this is a refundable tax credit for working people of moderate income, you can apply for it and have that refundable credit sent to you as a refund. And what I mean by refundable, just to refresh from last week's presentation, some tax credits simply reduce the tax you owe dollar for dollar. But if the credit is larger than the tax you owe, they don't send anything back. If you have a refundable credit, like the earned income tax credit, which is refundable up to $1,400, if you owed less than $1,400 in federal income tax, you could get some of that money sent to you in the form of a tax refund. If you've been paying on your federal student loans, particularly if you have been in the Public Service Loan Forgiveness Program, it might make sense for you to request a refund of loan payments that you've made between March 13th, and this has now been extended till September 2021. And I say in particular, anybody in the Public Service Loan Forgiveness Program, even though you're not required to make payments, you are still getting credit for $0 payments being made. So the clock is still ticking, and that could be more than a year's worth of payments that cost you nothing, but still count toward the 120 that you need to make in order to have the balance of your student loans forgiven. We went over the Public Service Loan Forgiveness Program last time, and I hope that if you were interested or eligible, that you looked at some of the resources to check out how to enter the program. This is the website for the State of New York Comptroller's Office. They talk about all the money that they have returned to New Yorkers in the form of unclaimed funds. So I do encourage you to start at missing money. When you put in a New York address, it will take you to this website. You continue to look, see if there's anything listed under your name. And I'll be honest, every time I've given this presentation, people have done it while I'm talking and have somebody in the audience finds money. I've found money for clients. I've found money for relatives. It's amazing how much is there. Check also any states you may have lived in before. For example, if you did your undergraduate work in California or someplace else in the country, check there too, all of your addresses. You may have left some money behind and not be aware of it, and it'd be kind of fun to get it now. Other money that belongs with you. If you've got money sitting in Venmo, remember that nobody's going to know you have money in Venmo if you get hit by a bus. So it may be in your best interest to move all but a very modest amount into your checking account where you can keep better tabs on it. If you've got credit card reward balances building up, maybe you've been saving and hoarding these points or miles or dollars back to fund some glamorous vacation, don't let this become tens of thousands, maybe even hundreds of thousands of miles or points, because it's not growing at interest. In fact, every time there's a turn in the economy, the credit card companies and the airlines dilute the value of these points and miles. So use them as you go. They're not worth hoarding. And remember that many of the cards that offer rewards will allow you to take dollars back or apply a credit to your current bill. And that's a good way to sort of use it in real time and not waste it. Another opportunity, most of us receive gift cards to stores we may not really shop in anymore. Sometimes these are store rebates. When these things end up in a drawer, you don't use them. Even if you've used a little bit off of a gift card, there's an aftermarket for used gift cards. And this article is fairly interesting, and it talks about all the best places to sell or exchange different types of gift cards. So there's some websites that do really well with things like Apple gift cards, and others for Best Buy and for all sorts of other different gift cards. So it's worth a look if you know that you've got some of these sitting in a drawer. Another opportunity, if you're facing a period of maybe less than robust income, or and I also recommend this for people who are trying to save for a big financial goal, whether it's a vacation, whether it's a new baby, whether it's for a wedding or a big glamorous trip. upromise.com is a rebate organization. It was originally started by Navient and was solely focused on rebates that would be applied to a 529 college savings plan. They've separated, and now I believe they're fully independent. You can still allocate your rebates to go to a 529 plan, but what I like about it is now you can send your rebates to your checking account. If if you do online shopping, and most of us have picked up that habit during the pandemic, if you shop through their portal, meaning you just go into Upromise and pick one of their many, many, many different partners, you can see how much the rebate will be. And then every quarter, they send that money and transfer it into your checking account. I'm particularly fond of the restaurant and dining rebates. Even places that do takeout may be part of the Upromise Dining Network. And so, you do your takeout order and you get a little bit extra back. You link your credit cards to the account. This is a free account. Yes, they do market to you. All of the people who are rebate partners would love for you to shop with them, etc. But it's not obnoxious. They do email you, but it's not really too much. If you sign up for their MasterCard, the Upromise MasterCard, you can accelerate your rebate savings, but it's not really necessary. This is from their website, and you can see all of the information that they promote about how to save for college, how to utilize their online shopping portal, and how their restaurant program works. They have many, many, many periods when they have extra earnings back to school, end of summer, before the holidays, start of the new year. There's always something new going on. And they have a dashboard where they show you the enhanced rebates. So one of the things I like about it is they do include some travel websites that I use. And so that can be a good way to get rebates on things that I was likely to shop for anyway. And here's an example, my little redemption back in August. This was entirely for takeout dining and local restaurants, but it was kind of nice to get a little notice, $20 going into my checking account. So granted, we're not saving lots doing this, but it's a nice way to enhance your rewards on your free annual reward card. Let's talk a moment about expanding our spending power. This can be really critical if you're facing a period of unemployment, lower than normal earnings, and spending power is your income plus your savings plus your access to credit. Because all of us, if we optimize that formula, can buy on credit more than we could sustain with our present income. This can be very, very helpful if, for example, you're a graduate student not making a lot of money. You know you're going to be in this situation for 1 or 2 years before you get a higher paying job. This might be a good time to consider extending your credit limits, maybe applying for a 0% interest credit card. So if you know, for example, you've got 18 months that you're going to be working, not a lot of money beyond your essentials, you could use a 0% interest credit card to pay for things that you know you'll be able to pay off at the end of the 0% interest period. If you own a home, you're in a different situation. You might want to, and you're anticipating big expenses coming in. An example might be you are working with your parents, you know that there are some big medical bills might be coming, might be a good opportunity to take out a home equity loan so that you've got cash on hand. You don't have to raid the 401k plan and worry about the tax bill. This might be a reasonable thing to do. You could also consider a home equity line of credit. This is something I recommend to a lot of people who are getting ready to retire. It is far easier to get a home equity line of credit when you are still working and have an income. Even if you own your house or apartment outright and have no mortgage anymore, they use your income as part of their underwriting to determine how much of your equity they will let you access. And the way with a home equity loan, it's a second mortgage on your property. It's not going to be as big as your first mortgage, but that can be, if you need it, that can be helpful. A home equity line, you will get access to a certain amount of your equity. They will approve you maybe for 50,000, maybe 70,000, maybe 100,000, but you don't take it out all at once. It's like a draft account. So this is very helpful, for example, as a backup emergency fund for new retirees. You don't pay interest if you don't use the money, but you have it there in case there's a big medical bill, in case you need to replace the roof or get a new car, some kind of an emergency like that, where you don't want the tax event of pulling money out of your 401k plan. The way it works with the equity line of credit, you have 10 years to use the draft. If you use it and you write one check at a time, say you're doing some projects around the house or what have you, you can use the money for anything. As you pay it back, you can use it and repay it during the 10 years. If you still have a balance at the end, meaning that you've used a lot of the credit line, that will revert to a loan, like a second mortgage, with a stated rate of interest and a period of time over which it will be repaid. So it's great to use, particularly for situations where you don't know how much you might need to spend. Another thing you might want to consider doing if you're facing some income uncertainty in the future, particularly now with interest rates so low, refinancing your current home mortgage on your condo or co-op or house. Remember, if you're paying a mortgage, say you have a 30-year mortgage, you pay the same amount every month for 30 years. And there, if you ever look at the amortization table, which shows you how much principal versus how much interest you're paying, it sort of goes down. It's like an X. In a 30-year mortgage, 15 years, you're paying mostly interest, and then it flips. 15 years, you're paying mostly principal. You are lowering the principal with each payment you're making. So if you were to refinance a mortgage, maybe you're 7 years, 10 years in, if you refinanced, you'd have a lower principal amount for your new starting mortgage. You extend the term back out 30 years, you get a new lower interest rate because they're so low now, you will end up with a lower monthly payment. You could also consider a cash out refinance where you take a little bit more money, have a slightly larger mortgage, or maybe you bring it back to where you started your mortgage, your first mortgage. With that lower interest rate and the same loan period, you could have the same monthly payment and put that cash aside either for an emergency use, or once the emergency clears, if you use the money for renovations, you can take an interest tax deduction if you itemize your taxes. We do want to think about using credit to avoid spending down savings. If you're in a tight situation, consider paying only the minimums on your cards on a temporary basis till the smoke clears and you kind of see your way through. You could also consider transferring high interest balances to a 0% interest transfer card. Now, these are easy to get with a high credit score and current income. So this is something I've had people, as I mentioned, come to me, clients who are facing the potential of a layoff. This is where we send them first. Let's go get a 0% interest transfer card or 0% interest new purchase card. You may not use it, but get it approved while you have a paycheck. And places to look for these, bankrate.com, NerdWallet, and Magnify Money. They all do. Bankrate, I've referred to before. You can look apples to apples comparisons for each different type of card that you might be interested in. NerdWallet and Magnify Money, they do annual reviews of the best cards in each category. No fee, 0% interest, travel rewards, etc. Let's spend a couple of minutes talking about managing credit. Most people don't necessarily have a good understanding of how credit works, meaning the difference between a credit report and a credit score, and how to manage their credit score to make sure they keep their interest affordable. So the essential difference, a credit report is literally a detailed history of all loan and repayment activity, whether you use credit in the form of credit cards, store cards, bank loans, car loans, student loans. All of that is on your credit report. And whether you've made any late payments, if you've defaulted, if you've been taken to court for non-payment, all of that would be included on your credit report. The credit score is a number between 300 and 850 that summarizes the activity on the report. And it's used to predict future repayment behavior. So obviously, if the information on the report is all good, all the payments are made on time, that gets scored very highly, and you have a high credit score. This gives you access to cheaper credit products, lower interest rates, lower mortgage rates, etc. Where do you get a credit report? There is one place where this is free, and this website, annualcreditreport.com, was established by Congress as part of the Fair Credit Reporting Act in 2003. It is very important to type this website into your browser. Do not Google it. I was watching CNBC last night, and they put this website up on the screen without that caution, telling people that at the present time, given the pandemic, given all the people who have run into financial difficulties, that it's important to check your credit report for erroneous information, particularly if you have a common name or you have a family name, multiple people named John Brown, for example. You could end up with information kind of cross-pollinating one another's report. But they didn't say not to Google this, and many people will. And the problem with Googling this is that there are about 24 imposter sites that I saw the last time I put this into Google. And they look just like annualcreditreport.com. What they want you to do is go to their site, type in all of your personal information, and they're going to ask for your social, your date of birth, your home address, your mother's maiden name, all of that stuff. And then you're going to hit a button and they're going to ask for a credit card number. And what they're doing is selling you bogus credit monitoring services. And it's really hard to get this scraped off your credit card once you've done this. So make sure you go to the right one. When you go to annualcreditreport.com, when you arrive at their homepage, you're going to see a lot of language. Check your credit report each year. Make sure you have no signs of identity theft. And there are 3 buttons for each of the 3 main credit bureaus: Experian, Equifax, TransUnion. You can click on one. By law, they're all supposed to have more or less the same information. There may be some timing differences, but they have the same information. And they differ in terms of how the report is laid out and the keys they use and things like that. But it's basically the same stuff. I'm a fan of Equifax. I think it's an easier one to look at, to read, and their glossary for what all the little abbreviations mean is pretty straightforward. So you click on the Equifax link. It hyperlinks you to Equifax's website, but they don't know that you're really you. So the first thing each one of these agencies is going to do is give you a little quiz. They're going to ask you 5 to 8 questions about personal financial credit products that you may or may not use. So for example, they may ask, what is the make and year of your leased car? And you have to look down and see, well, it's a Ford from 2003. If you don't have a leased car, you would know to hit NA, does not apply. They'll ask about your mortgage payment, your credit card payment, things like that. You have to pass this quiz, answering each question correctly, in order for you to move on and have access to your credit report. So once you clear this hurdle, you go directly to your credit report, and you can view it online, or you can download it and print it and then close out of the website. If you prefer to call, you can call and get this. I've had clients tell me that it's not too bad to call up. They didn't have the patience to go online and do the whole download. But it's important to get it and to look at it to make sure that the information on it is correct. This is the number one way that people discover that they have been a victim of identity theft. They open up their credit report and see credit cards they don't own, mortgages they never took out, student loans in their name that they never took out. So you have to make sure to check it to make sure that it's clean. Very important to do this well ahead of applying for a mortgage. So when you're first thinking about going out to buy an apartment or a house, generally you make that plan about 6 months before you get started. It's a daunting process, finding a place, getting financing, the closing, all that sort of stuff. But you want your credit report to be polished before you begin so that you don't run into problems qualifying for the mortgage you need. So start early. What you're going to look at first, page 1, is all of your demographic information. So your full name, your date of birth, last 4 digits of your social security number, your current home address, your last residential addresses. They go back typically 7 years. Look for anything that doesn't look right. Even past addresses that aren't correct, challenge it. You can go online to each one of these credit bureaus and submit a correction request. If you see unfamiliar credit accounts, that's something you need to jump on immediately. They have 22 days by law to do the investigation, remove it, or update it, whatever needs to happen there. If you have negative accounts, there are a couple of things to know about them. Paying off a negative, and what is a negative account? A negative account might be a credit card that you kind of forgot about and it went into default, you stopped paying it, went into collection, you ignored it, and now there it is as a negative account toward the bottom of your credit report. So the way the order is demographic information, accounts in good standing, accounts with problems. So the deeper you get into the report, if you've had problems in the past, in the back pages, you're going to see all of this negative information. If this account is old, for example, say you had trouble back coming out of the great financial crisis, 2009, after the market collapsed, people were still being laid off, things were really grim. Maybe you couldn't keep up with this credit card, you left the balance and you didn't look at it. In New York, consumer accounts like credit cards only stay on your credit report for 6 years and a day. So we're more than 6 years beyond. So technically it shouldn't be on your credit report. You can challenge it by going online to submit the correction to have it removed. If you had something that a credit account where maybe you missed a bunch of payments because things got a little crazy last year, for example, working too much, pandemic, whatever, got distracted, forgot to make some payments on either a credit card or a loan. So now you've got some negative information. A couple of things you can do. You can submit comments to explain what was going on when you forgot to make those payments. That can give some context to anybody doing a review of your credit report. Maybe you've applied for a new card or some new loan. It would give them some context. If you owe a little bit of money and can pay it off, that can clean up a negative account, remove it as a negative item and put it into a better status. But those are things that you would have to find and consider depending on what's on the report. Let's talk a minute about the score and how this is devised. It is kind of curious that we're all given credit scores and we don't feel like we have a whole lot of input into it. Although I will tell you that your credit score is more determined by your behavior. In fact, it's 100% behavior. It's got nothing to do with your income level. So there are people who have very, very modest incomes. Think of people who are retired and living mostly on Social Security. They've got stellar credit scores, beautiful credit reports, and there are people who make gobs of money whose credit reports and credit scores are a complete mess. Payment history is your history of making payments on time. So if you've been good about paying your credit card bill, your student loan, any personal loans or mortgage that you've had, this is going to reflect well. The longer that history is, the more positive that 35% of your score will be. The next item is the secret sauce. A lot of people don't understand what's called the credit utilization ratio, which is how much of your available credit limit do you actually use? If you use more than 50% of your available credit limit, even if you pay that card off every month, it weighs your credit score down. It's simply the way it works. You look like somebody who might have cash flow problems. Why do you need to use so much credit? So that is a factor. So 30% of your score is made up by how much of your available limit do you use? And it's measured on individual cards and also across all of your cards. So it's kind of a tricky number. The length of your credit history is worth 15% of your score. This is why people who've had credit cards since the 80s, so older Americans, tend to have higher credit scores than younger Americans. They've simply been at it longer. Applications for new credit are worth 10% of your score, and that can interact with your length of credit history. It's kind of a goofy thing. If you are somebody, for example, who's had one card since 2000, so here it is, we're in 2021, and next week you go out and you apply for 3 new cards. All of those are 0 years old. So you have a card that's 21 years old and 3 baby cards that are 0 years old. When you take the average age, you shrink that length of history, and that's sort of negative. So that can be detrimental. So the standard advice is don't apply for a lot of new credit in a short period of time to avoid that from happening. The other component of your credit score is the types of credit you have. Not that one type is better than another, but they're essentially 2 different types. There's revolving credit, which is your credit card. You owe a different amount depending on how you use your card month to month. It revolves, the balance revolves. And you have installment loans. So your mortgage, your car payment, your student loan. An installment loan, you pay the same amount, due the same date for the term of the loan. Having both means you have a more complex, robust credit profile. And this is additive. So this is a positive boost to this 10%. And again, this is why typically older Americans tend to have higher credit scores than younger Americans. They have all of these products. They've had them for a long time. And this over time gives them these 800 credit scores. Places to learn how to better manage your credit score, specific techniques for improving your score. American Express recently introduced Express Score goals. Yes, you need an American Express card to link it and then track your score progress. They give you access to your FICO score, and they recommend things to do to help you improve it over time. Another great source of information, and you don't need to purchase this service. Credit Karma has a lot of really good recommendations for ways to improve your credit score, what you should know about credit, how it works, things that are myths, for example. There's a big myth out there that you need to carry a balance to improve your credit score. That's not true. So Credit Karma is a good source of information and guidance on ways to improve your score and to debunk some of these credit myths. Let's talk for a minute about accessing your investment accounts. If you're anticipating an emergency or you're looking to shore up your financial situation because your income has been limited, Consider the tax consequences of making withdrawals from certain types of accounts. So, for example, it is often tempting to say, well, I've got all this money in my retirement savings plan at my job, 403B plan, 401k plan. If I need to, I'll just pull the money out of there. Remember, last year, under the CARES Act, they waived the 10% penalty tax for people who are under age 59 taking money out of these retirement accounts. That's not true now. So if you take money out, you owe income tax on that withdrawal. You also owe a 10% excise penalty for being under 59 and a half. If you have a taxable brokerage account or a mutual fund account, meaning you just have a regular investment account, maybe at Fidelity or Vanguard or Schwab, you can absolutely take your money out. Remember that when you sell these investments to take the money out, you're going to have some tax consequences, probably capital gains. Some of them will be short-term if you've owned the investment for less than a year. Some of them will be long-term capital gains if you've owned it for more than a year. Last week, we talked about the tax implications for and the special tax rates for long-term capital gains. This can be a good place to go if you need to sell something to pay your bills, because the capital gains tax rate for long-term gains is very favorable. The other option you may have, if at some point you set up a Roth IRA, and remember with the Roth IRA, you can contribute up to $6,000 if you're under age 50. You use after-tax money, meaning you just take the money out of savings or out of your paycheck and you put it into the Roth. You don't deduct it on your taxes, so it has no tax benefit when you open the account, but it grows tax-free. And then after age 59 and a half, if you've had this account for more than 5 years, you can take both your contributions and your earnings out tax-free forever. The thing to know about Roths is that you can always take your contributions out for any reason at any time, no questions asked, no tax consequences. So it can be a very good backup emergency savings account. As you are rating these retirement accounts, though, do consider the loss of compounding. When you contributed into these accounts, it took a long time to amass the balance. You're putting in a percentage of your paycheck, paycheck after paycheck, month after month, year after year. And as that money is in there, invested, it grows, the growth grows. So interest on interest is how compounding works. As young people, it seems like it's going to take forever for these accounts to compound to significant size. The magic happens typically in your mid-40s, and by the time you are in your 50s and 60s, these accounts are much, much larger. In fact, your annual return from the investments typically are larger than the contributions you put in on an annual basis. So by rating these early, you're going to hamper compounding. So it is a consideration. The same thing would be true borrowing from retirement accounts, although over time, borrowing from a 401k or 403b has gotten a little bit better. They let you pay it back to yourself at interest. They sometimes let you put in money a little bit faster than, a dump in, for example, as opposed to making an additional contribution for years to repay a significant withdrawal. Tax loss harvesting. Just want to point out that if you sell holdings that are underwater, and we saw that the market went down 500 points, and Dow Industrial's down about 530 something, I think, today. If you were to sell tomorrow your beaten up shares in Tesla, for example, and realized a capital loss, you can use that taxable loss to offset taxable gains from the sale of winning stocks or mutual funds. Typically, this is done over the course of the year. There's a lot of this activity in the last quarter of each year to try to match the gains and losses, rebalance portfolios, and not create a taxable event for having made these sales. Long-term capital gains, we showed you last week that those have very advantageous tax rates. Short-term capital gains are taxed like regular income. So remember the tax brackets and the tax rates, 10, 12, 22, 24. So important to remember the difference. So in summary, as you are facing a financial crisis or period of great financial uncertainty, think about your priorities. Staying solvent, getting through this situation. To do that most effectively, create or update your spending plan, focusing on the essentials. Explore all kinds of options for finding money. Hopefully, you'll be a big winner on missingmoney.com. Now that you understand how to manage your credit report and your credit score, stay on top of that. It's important. And if you access your investment accounts to get you through periods of financial uncertainty, be tax aware. Don't compound some of your financial problems by making withdrawals thoughtlessly. I want to give you some resources, and I'll keep this up as we take questions. For learning more about all the topics we've covered in the program, if you're interested in learning more about saving, credit, and debt management, I've mentioned Credit Karma, Bankrate, NerdWallet, Magnify Money, but there's a great book that is the basis for a lot of my credit information, Understanding Your Score by Anthony Davenport. One of the great tricks that I learned from him, and I've heard him speak as well as read his book, he talks about credit piggybacking for people who have either damaged credit scores or very low scores simply because they haven't borrowed money. They have, no history of borrowing money, so they have a low credit score. Piggybacking is being made an authorized user on a credit card owned by a family member or friend who has stellar credit. So for example, I've done this with my college stage sons. I'm an old person. I've got a good credit score. I've put my son on, made him an authorized user on one of my older cards. And in about 4 to 5 months, what will happen is this history for this particular card is now part of his credit report. And after that many months, he doesn't really need to be on this card anymore. He can apply for his own on his own income, but this will be a boost to get him going as a young college grad worker. For investing, some great resources. FINRA. FINRA is the organization that oversees and regulates brokers. And on their website, they have great factual information about how investing works, all the terminology, asset allocation, types of investments, risk tolerance, all of that. And so it's a great place to look because they're not selling anything. They truly want investors to understand how investments work. I've mentioned acorns.com as a very easy way to get started as an investor with as little as $5 a month. Costs $1 a month, but you can do this out of your checking account. Stash works about the same way. And what I like about both of them is that they are committed to financial education. They send you little updates. They send you little newsletters. It is important to them that investors understand the terminology and gain experience as they're building their accounts. Robinhood has a surprisingly good website. They too, you're opening up a regular brokerage account. Do not get sucked into the options trading. That's my only warning because it sounds like a lot of fun, but it's an easy way to get hurt. But their basic trading app, investing app is very good and is pretty reasonable, but they've really gamified the option stuff. So stay away. Schwab.com, I mentioned this in our first session. They have stock slices, which is a way for as little as $5 to own a piece of all of the 500 stocks in any that you wanted in the S&P 500. So if you want to own a piece of Google or Amazon, you can do that for as little as $5. There's no fee with that. And so in that way, it's a bit superior to the other two accounts because there's no charge. The stock market game is a good resource for learning more about how investing works, introduction to economics, and Morningstar.com, which is a very good resource. They are the research company that was founded back in the days when mutual funds were first invented. So going back to the 60s and 70s, they began to do research and provide this to regular retail investors so that people could be more knowledgeable about the funds they were buying. It has expanded tremendously, and they have some very good editorial, great writers. I'm a big fan of Christine Benz, who has her 3-bucket portfolio for retirees, which is very well done. She does quarterly updates to tell investors how that's doing. If you really want to go deep, one of the best guides, and granted, I read a lot of these books. I read a lot of personal finance books. A lot of them are really tedious. This one is meaty, but it's very well written, and it is the best guide that I have found for preparing for retirement. It goes through all the decision points and things you should consider and think about: Medicare, Social Security, contributing to retirement savings plans, what to do with your brokerage account, all of that. Larry Swedroe is the portfolio manager for an enormous foundation, I think at Princeton, I forget which school. Enormously successful, one of the most successful portfolio managers in that space. So he's a bit of a legend, and he just spells it out. It's very readable, but like I said, it can be a little bit inside baseball in terms of how to structure an investment portfolio, but well worth a look. Lastly, I'm going to give a plug for Money Made Simple, the nonprofit that I do all the content development for. This organization is in residence at PSS Circle of Care, which is a grant-funded nonprofit that helps family caregivers. So people who are looking after aging parents, spouses with dementia, Alzheimer's, etc. And we do a program of personal finance webinars that repeats every quarter, and there are YouTube recordings of the past webinars. We also offer pro bono financial counseling sessions for anybody who signs up. And that's my list of resources. I hope that was helpful. So I'm going to open up the chat and see if we have some questions, and I'd be happy to answer them. Okay. All right. Here we are. Okay, I am donating funds through a GoFundMe account to a nonprofit. How do I get the tax credit for the donation? That should be on the nonprofit to issue that. If you have given more than, well, they owe you a receipt in any case, but they're absolutely obligated to give you one if you've contributed more than $500. So you should be able to reach out to them and ask for the contribution receipt.
So Anthea, that question was for me. So this is the challenge here. First of all, how are you doing today?
I'm doing well, thanks.
Good. This is really some good information. So I'm donating this to a school, to my alma mater. It's for a reunion. And we have a GoFundMe campaign to collect money from all the class members. And one of the people are asking, well, how do we get a tax credit for this donation? It is not clear. I mean, the school in the past has not sent out receipts. They just collect the money as a donation. So,
So each contributor on GoFundMe gets a little receipt saying how much that they have contributed. So I wonder if you could have your contributors take a snapshot of it and send it to either the Office of Alumni Relations or whoever you're working with to raise this money, and ask for the tax letter.
Okay, but you need a tax letter in order to get the credits, is the point.
So you can take the risk of not being audited. If you don't have, if you've contributed $500, you can take that deduction. And if you do get audited, then you're going to scramble and have to reach out to them and say, look, I made this donation, send me the letter really quick. But you don't attach it to your tax return. They just ask you how much have you contributed in cash or goods, and how much was it worth.
Okay, thank you.
You're welcome. Okay. Let's scan back, look. Okay. Good day. I had a few questions I collected from friends about garnishments. I was hoping you could answer tonight. You can email them to me. That'd be perfect. And I will help you answer those.
I have a question.
Sure.
A lot of times in our life, we experience the check to check aspect of
Yes.
working, and every time you feel like you get your check, the money is gone. How do you explain to somebody the best way to manage their money if they feel like they never make enough to ever save or for a vacation or a home and stuff like that? What would be some of your suggestions for that type of person?
So some of my suggestions for people like that go back to the recommendations I made in our first session, which is if you keep a spending journal, even people who live check to check have little leaks in their budget, little impulse spends that happen that they're not even aware of. And if they write down what they spend and commit to starting small, maybe you're just looking to save, $2 a day or $20 a week or whatever it is. If you start to search for those little amounts of money and you keep at it and you monitor it, that can be super, super helpful and get you on your way to creating, first of all, a habit of saving. So you get a little bit more money, maybe you get a raise, you have this developed habit of saving money, you will know to put part of it aside. Other things for people who are in that situation, automatic contributions. If you have trouble doing this, proactively, setting aside the money into a special account, you can do a split deposit with your paycheck. And maybe it's only, $40 out of your paycheck goes into the special savings account because everything else is so tight. That would be very helpful. I mean, beyond that, you are looking at, other ways you can make money so that you can speed your savings and accelerate the growth of those savings and kind of get you out of that paycheck to paycheck situation.
Okay, thank you.
You're welcome.
Hi, it's Anita Wallace. I have actually two questions.
Sure.
You mentioned the Roth IRA and
Yes.
contributing if you're under 50, correct?
It's good if you're under 50, simply because you have so much time for this to grow and compound and be free when you take it out all those decades later. But if you're over 50 and you're eligible, still well worth doing. Well worth doing.
Okay. And the second question is, I recently found out about a SPIA, a single program immediate annuity.
Yes.
Is it less taxable than a Roth IRA?
So I'm going to go get on my soapbox about insurance products. The reason you buy a SPIA, single premium immediate annuity, is to get a series of checks. You turn a lump sum of money into a series of payments that may be as long as your life. It may be 10 years certain, or your life plus a spouse's life. But that's what these immediate annuities do. They're payment plans. They're helpful for people who, for example, may not have a pension. They may end up at retirement with a good-sized 401k plan or other savings, and they want the security and comfort of a regular paycheck. So they would purchase a SPIA, they buy the contract, and the checks will begin. So that's how that works. So it's very different from a Roth.
Okay.
You could use a Roth to buy a SPIA.
Okay. Well, the thing is, unfortunately, my mom passed away in December, and we're trying to figure out what we're doing with some of the money. So we did have an advisor who was suggesting the SPIA, but it seemed like the focus was for us to not pay as much taxes on the money.
So you as inheritors, depending on how her money, what types of accounts her money are in, you're not going to pay a lot in taxes. So for example, if she has a savings account, you don't pay any tax on that money. The only time you pay tax on the money is if you're the beneficiary of an annuity,
Right.
or an IRA, so a retirement account.
Okay.
With the retirement accounts, it is a little challenging. You've got 10 years to take the money out of the account. So if you do it in 10 equal payments, you're going to have the tax problem for 10 years if it's a lot of money.
Okay. Thank you.
You're welcome.
You have a question in the chat?
Yeah, okay. Here's a comment. My dad made me an authorized user on his card when I was in college. Very helpful. That's great.
That was me. That was excellent.
Yes. Excellent. Okay. All right. Credit piggybacking. Does it matter who authorizes you? Should you ask someone with the same last name? Can you distribute it among 3 people? And will that advance your credit score, repair, and increase? Or would you advise one person, transfer after 6 months, and then a second person for 6 months? So here's the thing. When you do piggybacking, you're an authorized user on somebody's credit card. So you get a credit card, it's part of that account. You don't actually have to get the card. You don't even have to make spends on that card. The card does not have to be used. You just need to be authorized on that individual's card to get the benefit transferred to your credit report. It does not matter if it's somebody with your same last name. So if you're more comfortable asking a best friend who's got stellar credit and great bill paying habits, very dependable, if that's an easier ask, then you can certainly do that. You don't have to be related, so that part doesn't matter. Distributing it among 3 people, will that advance your credit score, repair, and increase? If you can get 3 different people to add you as an authorized user, and again, you can assure them, don't give me the card, I don't need the card, there's no risk to you. That would add 3 great accounts to your profile. It's all happening in the same period of time, so I'm not certain that this will do as dramatically more, but it will enhance and give you a more complex, positive credit report that will certainly help you. I just don't know if it'll be 3 times as helpful.
Do you mind if I jump on that question?
Sure.
So I would let everybody know that was one great advantage that I had from my mom growing up.
Mhm.
My mother was a vice president of wealth management at the bank in New York, and she had me and my little brother as teams with cards, but we had to ask for approval to use the card. So whenever we wanted something, like say we want to pay a sneaker, something like that, she would say yes, just stay within this limit, so she knows how much to budget. So it's a great advantage, because when I moved out of my parents' house at about 18, 19, I was able to apply for credit from like IKEA and stuff to furnish my apartment. I was able to get my own computer for school. So it can help you, but at the same time, when you lend out your credit to other people, you got to make sure you can trust them, one,
Mm-hmm.
and the person that's adding you to their account, if they already have bad credit habits, because it affects everyone.
Yes.
So if you give your card to somebody that doesn't pay bills and runs up
Yes.
the money, it can mess up your credit score.
Yeah.
If you add yourself to somebody's card and they use their card on a regular, it can mess
Mhm.
up your credit score as well. So
Right.
you just have to be aware of who you're trying to help, or who you
Yes.
choose to put your information with the other person.
And this is why I suggested that if you ask somebody, say I wanted to improve my credit score, I'm just out of school, I've got a very thin credit profile, I would ask and say, don't give me the card. I don't need it, because you don't need to make purchases with that card to prove your credit worthiness. All you're looking to do is to draft on your high credit score friend or relative and import their information and good credit habits onto your report. So that's no risk to them, because they're not giving you the card.
I had a question, since I don't see any other ones
Sure.
in the chat box. When you were talking about the missing money website,
Yes.
if you run names of, say, family members that you know that have passed away, would you be able to still claim whatever money's out there, or is it no longer accessible?
So if you do that, and I did that, for example, when my father passed away, I didn't find anything. He was very on top of his stuff. The executor of that individual's estate, so whoever is named executor, could claim that money, and they would just have to send the usual form.
Okay, thank you.
You're welcome. So, any other questions?
You got one in the chat box.
Okay. Can you talk about insurance deductibles? Higher amounts, less monthly annual payments. Yes, this is a great thing to think about carefully. Most types of property insurance, so whether you're talking about car insurance, homeowners insurance, renters insurance, will offer you the ability to change the deductible. The deductible is the amount that you have to pay to cover damage before the insurance company picks up and pays for the rest of the claim. The higher your deductible for your car insurance, your homeowner's insurance, the more you need to have in the bank to cover the event of an accident or problem of some sort, but it will make your premiums, your insurance premiums, much cheaper. So one thing you can do, you're allowed to change your deductible pretty much anytime you want. So if you're starting out and you're just beginning your job, or you're a graduate student on very limited income, you've got car insurance, you could have a very low deductible, because, maybe you could scratch up $500. If your car got totaled, you would be responsible for the 500. The insurance company would cover the rest. You would simply have to handle the higher monthly or quarterly insurance premiums. You start making a little bit more money, you've got a little bit more money in the bank, maybe you double your deductible, maybe you triple it. People do this, and I recommend it. You buy a house, you have to have the same thing. You have to have homeowners insurance in order to get a mortgage. With the insurance coverage, you can pick the deductible. And if you take a high deductible, you simply have to be certain that you've got the cash to replace the roof, or at least pay for your portion of that bill if a tree falls on it, for example. So it is a good way to manage the cost of insurance, but you do have to have access to savings so that you don't get stuck.
I just add something to this, and I think it's one of those things that folks don't pay enough attention to. It's like paying the minimum payment on a credit card.
Yes.
You're killing yourself. And so
Yes.
you take the lowest deductible for fear that you're going to have to come out of pocket with a big expense. But every month, every quarter, you're paying this huge payment to the insurance companies, which is ridiculous.
Yes.
That's why I raise this issue. People should really take a look at it.
Yep. And to plan to raise your deductible over time. As your income goes up, you should be planning to cover more of the deductible and save yourself that money. Okay, another question. When a card defaults due to non-payment, does who the lender is have a greater impact on the credit score? Well, not typical. Well, that's kind of a yes and no question. So the bigger lenders like American Express are very mainstream, very visible, and defaulting to American Express, which is very aggressive about going after defaulters, by the way, could potentially be more impactful, and not so much in how the score is calculated, but in how credit underwriters would look at your credit report. The fact that you might have a Lane Bryant card that went into default, somebody underwriting you for a car loan or a mortgage might not be quite as concerned, because those are specialty cards. They're known as high interest cards, and people, they're more of a history of people having trouble with store cards. Can I talk about student loans and consolidation? So consolidation, if you've got federal student loans, you may come out of school with multiple loans, all payable to different servicing agencies. There are about 8 different agencies that cover and take payments and communicate about student loans. And that can be confusing because you're making payments in all these different directions, particularly if you don't automate these. And a lot of people want to consolidate them so that you have one payment and it's not as much of a headache to stay on top of. You have to know a couple of things about this before you decide to consolidate. When you consolidate, you're going to get a weighted average interest rate. This means that if your biggest loan also had your highest interest rate, the interest rate you'll get on the consolidated loan is going to be higher than what you were originally paying on some of the other less expensive loans. So it could end up costing you more money. The other thing to be careful about with consolidating is once you consolidate, you can't unconsolidate. So for people, for example, who are never going to go into public service, don't plan to work for a 501c3, research hospital, government, whatever. So they're not planning to do public service and look for forgiveness. They might stay in the corporate world. I often recommend to them that rather than consolidate multiple loans, look at refinancing them one at a time to sort of hedge your bets, so that if, for example, you're off in the corporate world and you get laid off, you only have to really worry about your refinanced private loans and staying on top of those, because you can put your federal loans into forbearance and postpone making payments on them.
Hi, I'm Jamel Collins Day. I'm currently working on a PhD at Columbia University. And I'm looking at my financial situation is looking kind of ugly after I finish my PhD. Okay. So I know the U of T has a program, because I'm currently an educator, 17 years, that U of T has a program with loan consolidation. And okay. I'm just like, how is that going to look in regards to like me supporting my family and like, living the way I've been living?
Okay, so do you think you'll be a candidate for public service loan forgiveness?
I tried once before. I didn't qualify for that because I missed the window by like a year. I believe that the date was 1998 and I graduated in 99 or something like that. So
Okay.
those undergrad loans weren't forgiven, but they have another program. I don't know what it's called, but I was on a talk, and they were discussing about like further endeavors that I could get into possibly after I finish my degree.
Okay. So when you get your degree, are you going to teach? What's your plan going forward?
I'm teaching now. My plan
Okay.
is actually like to to teach at the college level as well.
Okay. Okay. So most of the colleges, including Columbia, it's a 501c3, you could enter the Public Service Loan Forgiveness Program. Are you teaching 20 hours a week or more?
Oh yes.
Okay, so you would be eligible now. When you were
Okay.
disqualified, and you talked about the loans prior to 1998, the types of loans that were issued prior to that date were not considered eligible for PSFL. Those loans, if you still have them, can be consolidated into loans that qualify.
Okay. Thank you so much.
You're welcome.
So as it's getting late, I think I just want to reiterate something I think you talked about at the beginning of this series. And I hope it's something that people are starting to resonate, because it is with me, that oftentimes at the end of the year, we go and have someone do our taxes,
Mm-hmm.
as opposed to having a tax advisor or a financial advisor. It's a very different thing.
Yes.
But frankly, I'm just starting to warm up too. Could you reiterate that point again as a take home for people
Sure.
as we close out?
Sure. When you pull together your documents to go do your taxes, and a lot of people assemble them January, February, and it's a bunch of receipts, and they take them to their tax preparer. The tax preparer's only obligation is to make sure that your tax return is correct. Once in a while, they will say something like, you should do an IRA contribution. You have until April 15th to make it happen, to reduce your income for 2020. Go do it. Promise me you will, and we'll take that as a deduction on your tax return. But that's the extent of it. The other thing that's true is that they don't do planning. So, for example, financial planners, that's what we do, it's in the name. Most of us are oriented toward saying, well, how much are you contributing into your 401k plan? Can we raise that and shelter more money? If you are a highly compensated person, are you taking advantage of the deferred compensation plan that's available to you, or the 457B tax deferred annuity plan that will help you shelter income? When are we, do you want to sell anything in an investment account? Can we do tax loss harvesting to make sure that we don't bump up your taxes as a result of taking money out of your investment account? So all of these things, if you think about them starting over the summer, really, you can put things into place. I always lean on clients in the beginning of the year, January, February. If it's been a while since you've raised your contribution rate into your 401k or 403b, how about we goose it up again so that you're contributing as much as you can? So tax planning is really a process. Different things happen in different years anyway that you can't predict. Sudden windfall, for example, that could create a taxable event. And if you think about it before it's time to do your taxes, you might have a way to mitigate the impact on your tax bill. So I see another really good question in the chat. Employment, do you think employers will use credit scores less frequently now versus before 2020? So I want to let everybody on this call know that in New York State, it's illegal for employers to use credit scores and credit reports as a basis for making a job offer or withholding a job offer. That was actually a law passed, and it only applies to New York State right now. In 2010, because it was deemed unfair that people who lost their jobs and fell into debt and damaged their credit scores then couldn't get a job that would fix that situation. So we are protected in New York. I think there's been a lot of attention to The challenges of using credit scores as any kind of predictive measure of how reliable or effective somebody is, I don't think it's fair. I think there is more sensitivity to how poor a measure it is and how unfair it is, because when you look at who got hurt in the pandemic, who lost their jobs, their businesses, all of that, it wasn't an evenly distributed pain. So subjectively, I think that there'll be less emphasis on this outside of New York, and we're happy to be in New York because it's not an issue. There is a carve out if you're applying to the police force, or if you're applying for certain customer-facing jobs in banks, they still have the right to check your credit before giving you a job.
I had one final question before we close out.
Sure.
Could you go back to slide 9 on your presentation?
Sure. Okay.
This one here. I was just curious to know, when we're trying to make our spending list like this, a lot of times I've heard all my life that rent, mortgage should be at the top. I was curious to know, why did you put food and medicine at the top? Does the order matter?
So let's talk about what happened during the pandemic. We had a rent and mortgage moratorium, and there are people now, they've just been given an extension on the mortgage moratorium from March till June. I think this is being matched by rent as well. New York, again, we've got wonderful consumer protection laws and a great deal of sensitivity to how big an issue that is here, since we got hurt pretty bad early on. So in those situations where people had no ability to pay for much of anything, make sure you've got food on the table and you're paying for your medicines. Make sure you keep up your health insurance payments. You've got your cell phone working. Then worry about the rent or mortgage so that you don't fall too far behind. I'm actually counseling clients who have gone into forbearance on their mortgage on how much they can afford to repay over what period of time. So this is getting a little tricky. Do you tack it on to the end of the period? Do you make extra payments now? So that's a consideration. During regular times, if you are not in an emergency, obviously put the rent or mortgage, keep the roof over the house, no problems with your landlord or your mortgage company. But in an emergency, I vote for food and medicine.
Okay, thank you. Thank you so much.
You're welcome.
So with that last question, I'd like to say thank you once again. All 4 series were definitely a great learning tool towards not only just managing your money, but how to pay off the student loans. Everything was excellent. So we just want to say thank you so much for doing it. And any parting words would you like to say to the group?
Money seems daunting. I guess one thing that I would go back to my last slide, my resources. You don't learn personal finance taking one class. In fact, you learn over time, because it's one of those topics, if it's not something you're reading about every day, it doesn't stick. And it's the type of education that just in time works better than studying it well in advance. So for example, when you're about to go apply for a mortgage, then read up all the things you need to know about applying for a mortgage. It'll be much more impactful and you'll master it, I think, more quickly because you will be motivated to get it right. So keep at it. Wall Street Journal is a great source for personal finance. You can find it online. New York Times does a lot of good stuff on personal finance, credit cards, student loans, etc. So it's well worth endeavor. It's the key to having a financially secure and affluent life over time.
So I want to just, again, Anthea, thank you for another great series, echoing Anthony's words. And I just want to emphasize to the group, Anthea does this at no charge to us folks. She's donating her time because she sincerely is dedicated to this and she wants you to be financially literate and successful. And the goal of this program is that we're all into this mode of working for money. We don't focus enough on making our money work for us.
Yes.
And that's what this is all about. Making your money work for you so you can be more successful and achieve your goals. So thank you all for participating. Spread the word. We're going to do this again next year, God willing. And we just want more and more people to get involved and get this information. So thank you all again for your attendance, good questions. And Anthea, we'll be talking to you soon.
Terrific. Thank you very much.
Thank you.
Anthony and Anita, thank you for organizing. Everybody give them a hand.
Thank you.
They did this for free too.
Thank you, Anthea.
Everybody.
Thank you, everyone.
Have a good night. Stay safe.
Good
Thank
night.
you. You too. Good night.
All right.